This is fortunate timing because I believe 2 IPOs priced last night, and Craig has one on the way tonight. Not sure he can talk about that, but we'll find out. So this topic is about the thawing, hopefully, IPO market. Most of us have observed not a lot happening in the last year, and we're very, very pleased to have some folks here who can tell us what's been going on behind the scenes. And we're going to kick it off right there. So let's start with Don. Don, what are you seeing? Are there signs of more enthusiasm, or are we gonna come back soon?
Sure. Well, hopefully with 2 deals pricing last night, the market's back, which is great. So I think what we're seeing is a combination of things. There's I like to bucketize in a few groups. There's a group of companies that absolutely want to go public because of their ownership structure, maybe how long they've been held by a private equity firm, or a desire to create some liquidity for insiders. I think there are those that might be a little bit more price sensitive, and I'd probably put those into maybe tech or healthcare, where valuations have compressed a lot. They have the benefit of more timing, and they probably want to see how this window opens, how things trade, how some of the comparable valuations of their peer group recover or not. And then I think there's always a group out there that we saw, in 2001 that are purely opportunistic. I'll go public if everything's great and the stars are aligned, then otherwise I'm not. So I think what we're seeing is that first group who are a little bit more prepared to go public, have a structure or a motivated investor that wants liquidity. And to some extent, you saw that last year. In the deals that did go, they were mostly carve-outs with corporate parents, and they were a little less discriminating about valuation, so they priced them right. And I do think with the IPOs that you saw priced so far this year, they priced them at a big enough discount to the peer group that they traded well. So far, so good, and hopefully the deals that priced last night will trade well. It looks like they will.
Great. Tara, what do you think?
Yeah, I agree with what Don said. The pipeline is incredibly strong. The public market currency is a powerful one, and it's an attractive one. It helps companies grow and scale their business, and it's attractive for investors to be able to share in that growth and the upside there. So the backlog is very robust, and we are seeing, excitement just starting the year off, but we do see, a lot of our companies that are in the pipeline looking at the second half of the year to really pick up steam. What happened was there was uncertainty, and the market takes that uncertainty and reflects it in the market prices. And so a lot was, taking a step back, and as Don said, it takes a little while for the comps. So the valuations, 12 to 18 months to reset valuations based on public and private company peers. So we're seeing that the activity we're confident it's going to pick up.
Great. Ramey, I know that you've had a lot of clients who were planning to go public last year. What are you seeing? Are they getting readier?
A lot of them are sort of taking a wait and see approach, hoping to see deals come out and price well. I think they're probably in bucket 2 of Don's bucketizing. So they're taking a wait and see. They're looking at private capital to sort of bridge the gap, and they'll be opportunistic if the market is there, but they're not in a rush. And those that are looking at, they're really not looking for capital when going public. They're more looking to go public for the other reasons that Don mentioned of liquidity or having a public currency for M&A. So not raising capital this way as it's rather expensive at the moment.
Don, you were alluding to Mobileye, I think. So, that's traded well, I believe. But as you said, that was sort of incubated at Intel, right? So that was not, that's not exactly something we look at as a model for others.
No, as I said earlier, I think the deals that you saw last year were the 3 biggest. I think all were carve-outs, but they made the valuation attractive enough that institutions wanted to participate. And so I think what you're seeing so far this year is something a little bit different, which is some of the sectors that have had better momentum. In fact, the next tracker is solar, so all power and anything traditional energy is certainly a lot more attractive. It's a hot sector. those deals can price. I think the other one that priced last night was Hesai, which is LiDAR, which is electric vehicles. So again, a hot sector, lots of demand growth. So there are pockets of strength. I think a more robust equity market, John, probably ends up seeing consumer-facing businesses go. There was a confidential filing announced last week by Cava. There have been several other restaurant brands that are on file. I think what you'll probably see in the next wave later in the first quarter, early in the second quarter, is probably a little bit more consumer. That would show that we took the next step in what I call a healthier IPO market, and then we'll go from there.
All right, great. Let's bring Craig into the conversation. So, Craig, I think this might be your deal, so you don't have to talk about it specifically, but so TXO Energy Partners, that one, I believe, priced first week of the year. Now, that's limited partnership, right? So, big dividend play. Why did that work? Well, similar reasons.
Sure. Well, thanks, John, for hosting the event, and to the panelists. Appreciate you spending a little time with me this morning. So as Don said, that the market backdrop helps. A lot of the backlog we're talking about that we've been getting done at the beginning of the year, we're also looking at the fourth quarter window. It was hard to recommend investors move forward or and buy deals, and obviously companies therefore issue into a market that was obviously in tax loss selling mode and was just not being constructive. So we can always solve stuff with discounts, but if the buyers aren't there, it's not the right time to recommend it. So in the flip of the new year, we've done 3 IPOs. Don ruined my party this morning because I thought we had done the only 3 IPOs of the year, but apparently 2 other competitors. So that's good for the market. But TXO Energy is was about a $600 million equity valuation MLP structure. What's unique about the MLP structure is actually they're not taking management fees. It's the management team from XTO Energy. So they had obviously hit a home run with a previous company. They had a lot of shareholders that were looking forward to reinvesting with that management team. I hear that consistently from a lot of large mutual funds right now, that when they're buying IPOs today, they're really backing management teams. They're finding companies that they want to own 10% of for the next 3-4 years. The momentum IPO players are not yet back in the market. So people are really making long-term decisions and positions. So what's unique too about TXO is obviously we went out, priced it at the midpoint. The stock is up about 10%, plus it's paying a 13-14% yield. So that obviously is providing a nice attractive return for GARP. We were on that with another dealer that also has a large wealth management platform. We were prepared to go as much as 70% to our high net worth platform, and it turned out that only needed about 20 or 30%. So went over 70% institutional, which for an MLP is pretty unique. So it definitely highlights. And then the other 2 IPOs I mentioned, Skyward Insurance was off our KBW side of Stifel's platform. That's also traded well. That was a deal that was ready to go first week of December and then waited. And I think smartly was the first IPO this year. And then Mineralis is a therapeutics business that will price tonight at the close, but we've already closed the books, and that deal will come in good shape. So I would say we're pleasantly surprised. I think when we all signed up for this panel, we probably weren't expected to be as enthusiastic as we are, but obviously you're hearing that come through with some coffee.
Well, God bless the hurricane. Yeah, by the way, for those of you who don't realize, this was supposed to happen on November 9th, not February 9th. Ramey, as a Texas oil man, what do you think about, if I can call you that, the MLP, that's working? I mean, I'm sure that your firm has done a lot of work on MLPs. Is that something you expect to see more of?
I don't know. I mean, I was surprised by TXO. A variable rate E&P MLP is kind of a blast from the past. It's like this is the 3rd or maybe 4th wave of those, and they didn't all turn out very well in the 80s and then the early aughts. I don't know. By my math, it was more like a 19% yield at IPO, but maybe I was skimming it pretty quick. So I think, as Don was saying too, traditional energy is one sort of positive spot, just given commodity prices. And so I think there was a market for it. But it proves that you do have to be willing to price these things fairly attractively. So it's interesting that I'd love MLPs to be back. I think they make all the sense in the world. I think a lot of people do, but there's so many institutional investors who dislike them for one reason or another. Now, variable rate MLP, no IDRs, no management fee. So it's attractive as the structure could be, at least without doing some really heavy damage to it.
Tara, I'm sure
Yeah.
that NYSE has a few of those.
I'll just chime in on the energy sector. When you look at market performance across the sectors last year, energy was the only one that was significantly up, and it was up like 59% over the year. Even utilities was slightly down. So that also gives some energy to that energy sector, whether it's traditional energy or clean energy. But I do think that it was priced well. It was right at the midpoint of the range. Most deals that are happening are being priced within the range, which is a positive thing. And then the post-IPO performance, that 10% pop right at the open, TXO closed at 10% up too. It opened at 22, closed at 22, and last time I looked, it was like 22.50. So smooth and steady, priced well, established management team, and a good dividend yield. So I think that's why it's been going well.
Great. So, again, things have changed in the last 24 hours, hopefully for the better. I was going to ask, when might the window open? Hopefully it's right now. But when we spoke a few days ago, the five of us, I think we were talking about maybe we need another quarter, see what happens. Is that still the feel, or could things turn on a dime? Don?
Yeah, I'll start. I think the first issue to keep in mind, it's going to get a little quiet because the financials go stale the middle of the month. And so what will happen is you won't see a lot of deals, and then probably towards the end of the first quarter, certainly Q2. And I do think that's going to be a good sign of how healthy the market is, because you're probably going to see a broader set of companies across other sectors, and you'll probably see a number of folks flip publicly. If they're on file confidentially, they'll probably flip publicly. So that's going to be a good sign that people are willing to go. So I'd say that's probably the two things to keep a lookout for in the next 30 to 45 days.
Great. Craig, what are your clients thinking?
Yeah, I mean, obviously with the macro volatility decline, it gives us a little bit more of a perspective around, how we think about the rest of our backlog. I think every bank on the street came into this year sort of managing their budget and really looking at it as being second half loaded. And I think we got a little bit of wind at our back, just given the way that year-end numbers came out. So I think some investors, obviously, and you could see this in index returns, have been surprised at the upside. So to Don's point, the question is how much of that is really, sort of post, COVID bounce? Is that the right comp? So I think a lot of investors that I think are looking to build significant positions are going to want to see Q1 numbers also come out, which is then going to put us in, after numbers go stale and well into the second quarter before you see some. But there are some really high quality companies that we know are coming and have been obviously could have come out last year and are really waiting for that window. And I think to Don's point earlier, not surprising that you're seeing carve-outs, larger businesses, those that have sort of run businesses for a while, and therefore there's confidence that they can sort of guide and are investors can get very comfortable in their numbers as they look forward.
Yeah, the largest IPO of last year was Corebridge. They raised $1.68 billion, and that was a carve-out from AIG. And as all my co-panelists have mentioned, that strong, predictable management team, predictable operating income, recurring revenues. There's a mantra that gives investors the confidence to get out there, right, and put their money into it. So those are the types of companies that tend to have a lower risk profile at IPO and then beyond. So we are seeing investors picking up interest and taking some money off the sidelines, and it's exciting.
Yeah, I was just going to say, because both of those comments touch on what's actually happening in the public market, right? If you look at Facebook as an example, they did not report great revenue growth, but they cut costs and the stock went up. So that's telling you about the institutional market? I want profitability, I want stability, I will give up some revenue growth for a business that is going to perform better over the long term. And to some extent, that ties back to my comment about tech and healthcare. there's a lot of venture-backed companies that took capital to grow very quickly. They were chasing revenue growth, at the expense of nearer-term profitability. I think as you see these layoff announcements among not just public but private companies, they're retooling now because they know the institutional market is looking for profitability more quickly. The comps in the public market that don't have a clear line of sight to profitability, particularly in software and healthcare, I think people are a little bit more concerned about, because they do not, well, the one thing the public market doesn't want to hear after you go public is, I'm going to need more money in 12 or 24 months. So you do have to think about that IPO event, and the type of company that could do it now is the IPO is going to either solve for or be the last time you ask for more primary capital.
Yeah, I mean, it's an important, like software obviously has been a huge part of the tech IPO market. There was one last year for a business called ZeroFox that we worked on. And then what's going on in the venture healthcare world, the healthcare market obviously an incredibly important pipeline for the IPO market. The businesses that are coming out are later stage. And many of the VCs are not putting in equity checks in the private market. So what's going to happen is, for those businesses that are later stage, they're probably going to come public, maybe even sooner than expected, because there's probably not another round left. And for those that are in maybe phase 2 or others, it's going to be harder to find those checks. And you're going to continue to see these IPOs on the healthcare side that are sort of anchored by the venture investors that are already in, because they would prefer to invest in that company as a public business versus a private business. And I think that will also likely exceed expectations and probably pick up the number of IPOs that come to market this year.
Great. So for those of us who don't have a behind-the-scenes view like the four of you do, we can look at things like major indexes and the VIX. Something I think I just saw this morning is that the NASDAQ is beating the Dow Jones for the first 5 weeks of the year by the most ever. That seems bullish. And I think, Tara, we talked about the VIX. So Tara, what should be those of us who aren't having these behind-the-scenes conversations be looking at in terms of positivity?
Sure. So I think predictability and stability are both factors that are important for investors. So if we go back 5 years, you look at 2019, it was a little bit slow in the beginning of the year because we had a government shutdown. And then, IPO activity was okay. But the VIX, the volatility index, was actually on average through the year 15. 2020, which was then, at the time, a record capital raise year, the VIX was 30, mostly as averaged out because of the first quarter. But when you look at 2021, which then became the new record year, it was, the VIX was below 20. And that really is kind of that Goldilocks zone, or anywhere below 20 feels stable, more predictable. And in 2021, we had nearly five times the number of deals that we had in 2019, and nearly 5 times the proceeds raised than we had in 2019. So last year, it was definitely above the Goldilocks zone. On average, the VIX was 25.6. And right now, at last glance, we're below 20. And the range hasn't been fluctuating between like 17.5 up to low 20s. So it's looking good. Predictability, stability. Another thing is, as you were referencing in the public markets, earnings, that were half of the S&P have announced, a little over half, and there have been earning surprises on the upside on EPS of 71%, and revenue surprises on the upside of 60%. So I think it's good to get this through the cycle and get that predictability.
Ramey, do you have a thought on that? Or
Well, I'm kind of the worst investor, so if you ask me what you should look at my portfolio and do the opposite, anti-Ramey. So that's my only financial advice for the crowd.
Well, no, Craig. So I'm curious though. When you're consulting companies, that are waiting to go for it. I mean, how close are you looking at volatility? Is that something? I mean, you don't want things to price poorly. If the next day the market could be down 4%, that's not a friendly climate, right? So how important is this?
Yeah, obviously, I think it's important, but that it's obviously measuring the standard deviations in the markets, and we look at sort of the fundamentals behind that. So as I said, is the market getting firmer? We could have a VIX at 12, but buyers on the sidelines, and it's still not a constructive market, right? So there has to be a confidence behind it. Generally, those things do go together, as Tara reflected, but look, interest rate cycle is starting to get more clear. Peak inflation's probably behind us. You have, potentially a soft landing recession. Like, those are the things that we're talking about. And if you think about the IPO investor, it is the high end of the risk curve, right? So no matter, you can buy secondary liquid stocks all day long. And I even think even when the IPO market, reopens, you're either going to have smaller companies that are more GARPy in nature and more stable, like the sectors we referenced earlier, or on the growth side, you're going to see larger businesses come out first. And for those that are sort of more on the high end of the risk curve, they're probably going to be back. There's going to be, even Next Tracker had, indications on the cover, from some pretty significant investors sort of supporting the deal. So you're going to see us be unique in terms of the way we approach. There's going to be a story. We use something called Test the Waters heavily, and we partner with the people on this panel to do that in partnership. We will go see investors and have a lot of dialogue with them about the deal well before it comes. We don't want surprises in this kind of environment. We want, obviously, if we're making a launch decision, we want to make sure the board has confidence that we think we can deliver, and it's no surprise that these ranges right now are being set at levels that can be met, so that A, the stock can trade well, and B, because of the heavy test the waters process that's gone on. So, look, the multiple peers have normalized, that we've obviously benefited from the market coming down the last couple of years, but, you still got to get a software company comfortable that they can go public at 5 times revenue instead of 10 times, right? And that takes a little bit of time for board and ownership to sort of reset expectations on values. So I think the VIX is an important indicator, but I think those other confidence indicators behind it are really what we're focused on right now.
Great. So I want to get back to technology stocks a bit later, but let's talk about the backlog. So a year ago, presumably, all of you were looking at a lot of companies waiting to go public. How has the backlog evolved in the last year? Have some of them given up, decided to go another path, or are they still waiting in the wings? We can stick with Craig. No, Don, go ahead.
Yeah, sure. I think, well, you heard a few comments about it earlier, but I think it's fantastic, number one. I think there are a lot of companies that want to go. I think there are certain companies that have sought some solutions like pre-IPO financing. You see a little bit of that in the tech market. If you needed more capital, they have used some structured financing techniques to raise additional capital. But I think the answer is there's a large and growing list of companies because of the fact that the market's been closed as long as it has. I mean, last year, I think by stats was the worst IPO market in 30 years. So
yeah.
As you can imagine, it's like Joey Chestnut at the Nathan's contest. He keeps eating the hot dogs. At some point, he has to drink a little water to get them down. But no, there's obviously a long list of companies, and it's building.
And it's exciting because they're across industry sectors and geographies. And these are innovative, amazing companies that are now refocusing on fundamentals, getting kind of back to the basics, like the team up here said, looking at economically responsible ways to grow their business, looking at cost, and across industry sectors. I think that's the mantra.
Yeah, I would just add that if you think about who our clients are on the IPO side, right, most of the companies that are eventually coming public are owned by either private equity or venture. So as you can imagine, if they've all had record amount of capital and raised record funds, and to Don's point, continued to digest hot dogs, at some point they're going to have to figure out their exit plan for these businesses. And if we're coming off a record low year, it would obviously mean there's a huge amount of pent up demand. So I think the trick is actually less about how big is the backlog and more just about can the street get organized in a way that really manages the deals that come out, how they perform, and not sort of get ahead of themselves in terms of it. And I do think that there will be some drama around how long these windows stay open. If I'm concerned about anything, it's that the IPO market that we had in previous cycles has been so open and so long. I think it's going to be more episodic as we move forward, and as a result, we're going to have to make decisions about the order of backlog, and I think that coordination is not always the street's best trait.
John, to add one point to what Craig just said too, the other unique piece of this puzzle is for probably the better part of the last decade plus, you've been in a low interest rate environment. Typically, when the market shut down like this, private equity to private equity deals skyrocketed or buyouts happened, the financing market is all but shut. It's very difficult to get a deal financed because rates have skyrocketed. So the optionality that companies have has really contracted. So the equity market's a much better option. And if you kind of think about if you did an LBO of a business a year or two ago and you had variable debt, your interest costs have doubled. So at some point, there's going to be a pent-up pressure for them to get more equity into those businesses if they don't want to write the check. So it does, I think the public equity markets provide some better optionality than you have historically seen, because there's always been the cheap buyout option, and private equity firms are paying higher multiples. They are getting a lot more discriminating.
That's a great point, Don. I was actually about to ask Craig about that. We'll let him follow on. But by the way, never mind the Goldilocks market. I want the Joey Chestnut market. So anyway, Craig, tell us about I think you're going to agree largely with Don on that PE to P is more difficult because leveraged finance is frozen, right? So do you agree with Don largely?
Yeah, I think obviously it's not just the ability to get leverage and have to write a smaller equity check if you're going to do a PE to PE trade, but it's also the fact that you have to then, reproject your cost of capital if you were to keep that company private, right? So to Don's point, if you're willing to own it longer, there will be innovations in the private market, like we have seen alternative forms of capital. PE shops are calling us saying, hey, we like that public business. It was trading at 15, now it's trading at 4. Maybe instead of buying another private company, we should inject capital into an already public company that we could look at. So we're spending a lot of time around how does, PE, if they're willing to own minority, deploy that capital to get an attractive return. But I agree. I think to a certain extent, until maybe the recent pickup, if you were to have launched an M&A process in December or January, many funds were asking what's wrong with the business, right? Why now? If you're thinking about it, if the leverage finance markets are difficult, is there something that we're missing? I think we're getting past that, and I think with the IPO market in the second quarter being better, I think you're starting to see more M&A processes launch. But I think that, if you were willing to lever a business, 5 times, and now you're only willing to lever it 3 times because of the cost of capital, you're obviously going to pay a lesser price. So as Don said, that comparative of maybe we should just put the puck on the ice and take it public. Maybe, instead of doing a $500 million IPO, we do a $250 million IPO. That may be cheaper than private financing or a PE to PE sale at an enterprise value that we're uncomfortable with. Maybe we're comfortable now owning that, in a public format versus just 100% selling the company. But a lot of our clients on the PE side, they just historically have not used the IPO market. They will continue to sell companies, and that will be their first route. But we like to think as a firm, because we have a very good M&A business and a good IPO market business, that we can dual track more companies in 23.
Great. I want to talk about sectors a little bit. Let's zero in on one. I joke with my co-editor Jared here that we're green energy experts because the number of companies in that broad industry that we've interviewed and covered. Many of them have been your clients, all 4 of you. There are so many tailwinds there, and in fact, we have a panel coming up later with Ron over here and John, which is focused on that. But there are so many tailwinds. You have to think that there's interest in that sector. Can it work? Can that be the one that thrives this year? Don?
Sure. I think, next tracker price today, so that's really a proxy on solar, and we'll see how it trades, but it looked like they priced above the range and upsized the deal, so that's a real strong indicator. I think it kind of ties back to the broader energy conversation as a whole, which is, I think over the last year or so, people have come to the realization that energy transition is going to happen after we're all dead. It's going to take 50 years. And so traditional energy sources are going to have to coexist. So this isn't a flip of the switch. It's a decades play. With that said, capital is going to have to be deployed in a lot of green technologies, and the returns are getting better now because there's real incentives to do it, and you've got mandates at states, and there's not a day that goes by that a company doesn't make a carbon neutral pledge. However, the way to get from here to there is chipping away, and I think that's what you're seeing, John. So whether it's deployment of solar, some of the battery storage businesses that have popped up, EVs are going to have to cycle through, and ICE vehicles will decline over time. But these things are going to take decades, not a year. And I think you're going to see a lot of capital deployed in those areas. So I think there's a lot of interesting opportunities for companies that can develop economic models and attract capital to build businesses.
Well, it's interesting. Natera, this is a New York Stock Exchange company. It's a SPAC deal. We actually hosted them 2 weeks ago. So this is small nuclear reactors. It's early stage, but there seemed to be a lot of enthusiasm about it. I think this might be everyone's client. I don't know if we can talk about that, but I was pleasantly surprised by the interest in that deal. The turnout for that event was enormous. So even though I think there are a few ways, a couple years away from commercialization, but it could still get attention. Tara, what do you say?
Yeah, absolutely. I think that there's a lot of zealous support behind the innovation in the energy sector and how to diversify sourcing. And you're absolutely right. There was quite an appetite for that, and I don't see that ending, even if it does take decades for this transition to be realized. In the next few years, we're going to see the companies that are going to set the path for the future in this sector.
Great. Ramey, I hate to peg you as an energy guy. I know that your firm does a lot of that. You're more of an M&A IPO man. But what do you think about this nuclear stuff?
I mean, it's fascinating. I mean, we've worked on a number of deals around the nuclear space, mostly in SPACs. I think you're going to see differentiation. I mean, it's not like 2021 where it was sort of you could take anything public via SPAC or IPO. It felt. So I think you're going to see, Nextracker is not exactly, they don't own the panels, right? They're selling into the energy transition, and so there's probably a lot of companies that aren't going to be profitable or will fail in the medium long term, and then there are others that will have a lot of success by sort of selling into the energy transition. But you're right. There's so many tailwinds there with the IRA in particular, but there's also a lot of uncertainty. It's become divisive to be energy transition. I saw that Florida is proposing to subsidize gas stoves, sort of just to spite the anti-gas stove people. So there's a lot of noise there too, and so knowing when there will be profitability in transition is kind of the big question.
Great. Now we're gonna open this for questions in a few minutes here. So anyone who's got any ideas, just be ready for that. Something that I'm kind of pleasantly surprised that we're not looking at COVID-adjusted EBITDA anymore. Is that a good thing that we're kind of lapping all that, and you can look at historical numbers and not have to play with them so much? Don, is that something you talk to clients about?
Yeah, it's actually ties into the IPO market in some ways, right? I think if you take a consumer-facing business, how do you talk about your numbers a year and a half or 2 years ago when you may have been shut down in the prior year period? I think you're seeing certain things in businesses like commodities, labor, give or take, maybe not as much as people would hope, but some costs normalizing. And I think you're seeing some swings. I mean, if you take a look at digital businesses that boomed during COVID, Peloton and any digital fitness business, those businesses crashed a year ago as people started getting back out to gyms. They're starting to normalize now. So I think there's some puts and takes depending on what the business is. I think, yes, 23 certainly feels like it's a little bit more normalized and you'll have more normalized comps. And again, depending on the industry, I think to touch back on the oil comparison, obviously, start of COVID, the business looked like it was going away completely, negative futures. We never saw that in our lifetime. And then, in the last 12 months, we saw skyrocketing prices. So I do think you're just seeing some normalization now that the economy, consumer patterns, industrial behavior, things are getting back to what we're used to.
Yeah, and a lot of the supply chain disruptions have been solved, and human behavior, we're acting more like humans again, so some of those are encouraging.
Well, let's just really quick, and then I want to get back to tech, and then the last point on pipes. But Don, your firm does so much work with restaurants and retail, and you look at what happened there. What does it take for a restaurant or a retail company to prove itself? Is it because there's just not that much of a track record since everything was shut down?
Yeah, I think what you've seen in that sector, and it's true of the public companies, their businesses have pivoted. In the restaurant sector, they all talk about their digital business. Everybody launched apps. If you didn't have them, they've used companies like Olo, and so they've transformed their business. They talk about takeout. There are people that never thought they would be in the drive-through business that are big in Panera. Half of their locations are drive-through. I think if outside of fine dining, if you're building a restaurant today and you don't have drive-through capability, people will think you're crazy because they all think about just what has transpired in the last few years. So they're very technology forward now. They're certainly thinking about how consumers use their product, where they consume it. On the retail side, John, I think almost all, I don't even like to use the word retail. I like to use omni-channel. Everybody's got a digital business, right? They pivoted. They have to be addressing things like how consumers want to interact with the product. You're seeing a lot of traditional retail saying, hey, I'll find a way to deliver it to your home with a DoorDash partnership or something like that. So I think with all the delivery models out there, people have partnered with some. They've come up with their own. Even Walmart, in some of their territories, have worked on 1 hour delivery you're hearing about. So I think the point is they've morphed their models because they were forced to at the start of COVID, and now they're finding an economic way to serve consumers based on how consumers interact with their brands.
Yeah, it's incredibly innovative. It's inspiring. If you've ever heard Mary Barra at GM talk about their ability in such a quick time period, 30 days, to flip production from manufacturing cars to manufacturing respirators. Never in their history would they have thought they could pivot the business. But as Don said, if the demand is for drive-throughs and digital apps and to serve customers in a different way, I applaud the sector for really stepping in and accommodating that and being so innovative.
And maybe just a couple of follow-ups there on the consumer side. I think one thing on the restaurant cycle, which I do think is going to be a nice backdrop for 23, I think we're on like 6 or 7 of them. They will be larger brands. They will be brands that you'll recognize. They will be more scaled. They will understand they will have run restaurants through these cycles, pre-COVID, post-COVID, and that will obviously provide some scale. And I think we obviously need this next window to go well. Many names that you will have heard about. Once we have those go well, then we can bring out some of the more emerging brands. And that's going to be a key focus across really a lot of our core industry verticals. We want to see some of these more stable businesses get out, do well, prove, and then we can bring some of the emerging companies. But it's really helpful. And then on the retail side, to Dom's point, it used to be we would either cover something with an internet pod or we cover it with our consumer retail pod. Like those teams just by nature now work together, right? Some are in the tech group, and then on the research side, who we cover that business with, right? Many companies really wanted to be covered by the internet analysts because that's where the valuation multiples were. Now that's not always the case, right? Given what happened in the last cycle. So it really depends on kind of the business to business model. I think Don referenced a few that, frankly, a lot of those old internet or omnichannel models are now very much, focused on bottom line EBITDA as they look forward, even the delivery models. So I think that's going to continue to evolve, and I think those sectors will take longer to reopen on the IPO side.
That's an interesting point, Craig, because you're reminding me, I looking back, I'd know analysts at places like Cotu or whatever, Tiger Global, tech guys covering retail, right, because they had the same growth profile. So you're saying that's maybe not, am I hitting the same idea here?
Yeah, I think all of we have 7, consumer-facing analysts. I think all of them have some omni-channel backdrop in their coverage now, right? They very much understand it, and there's less of a, defined line. And I think even in bake-offs or RFPs, it's not just, well, we have to pitch with our tech team because that's what the client wants to hear. We really have to look at those businesses in a lot more detail and think about how they want to project their model. And there are certain circumstances now where a consumer multiple is more attractive than an internet multiple, depending on that sub-vertical.
Great. Now we're gonna talk about SPACs later on, but just real quick while I've got the four of you here, obviously, for anyone who's watching this, there's a tremendous amount of liquidation or deadlines coming up. Once this passes, it might be extended a bit. Will there be a normal level of SPAC issuance again, like we used to see, 5 years ago? Don, what do you say?
Yeah, I think you just nailed it. It's normalized, right? There were 2 SPAC IPOs, I think, in January. A normal amount for the market to digest is probably 40 to 60 or something like that. I think the wave of
In a year, not a month.
in a year, yeah, exactly. And I think the structure has proven that it works for certain companies, much like a direct listing could work for certain companies. Not for every company, but done right. And I think the market, we had been saying this going back to 21, that the market will normalize with serial issuers. There are a number of SPAC sponsors that are on SPAC 6, 7, 8. They were doing them before the boom. They slowed down in some cases during the boom, and they're going to continue to issue. DMY was one that did an IPO, I think, in fourth quarter.
Yeah, it was smaller. It was like 60 million or something.
Yeah,
right?
that was their 7th or 6th, I think. But that's a good example. I think 2 retired executives who were looking for a hobby and they raised $200 million to buy a business is not a good idea. I think folks that have set up the infrastructure, they can do due diligence, they have their own capital to get a deal done, or these arms of private equity firms like TPG and Gores, where they have a lot of committed capital into these, they can close a transaction. Neuberger Berman, as an example, set up a partnership. They backstop their deals. I mean, they can backstop a deal up to $250 million, so they can guarantee somebody they can close a transaction. Those are very different than somebody doing it as a hobby.